Okay, another week behind us with an ugly retail sales report. We'll have a look at that and we'll go through the categories. We'll see there really wasn't anything good about that report. Much like the last retail sales report we had for the month of November, there was nothing good in that either. I don't know that we should continue to ignore that. Let's have a look at our rates, money market rates. Really impressed with the 1 month, 4.69. It is now beginning to price in the next 25 basis point move that will most likely happen February 1st. Going from at the end of last year being well below the lower bound of the target range to now being above the upper bound of the current target range. And starting to price in that 25, it's starting to act in a more rational way. Capital market rates, as we see the 2-year here out to the 20-year, more rate cuts from the market. So year to date, we can see in red here how much rates are being cut by the market. So the Fed is in a tightening cycle at the short end of the curve. The market is in a rate cutting cycle at the long end of the curve. Who do you think is going to win, right? FOMC meeting, next one, February 1st. We can see down here at the bottom of the screen, there is some weight now on 0% or 0 basis points, 0.7% that there is no rate increase. All the weights on 25 basis points. There's not even a consideration of 50 basis points. And this in itself is creating the conditions for the market to rally and to loosen financial conditions almost to the point, possibly, of pushing the Fed to go 50 to make their point. So the idea that 50 is gone, it has no weighting on it at all. Last week it was 24.3% probability of 50, 75.7 on 25. That 50 is now just disappeared, and you actually have some market participants out there thinking there's a 0. Otherwise there wouldn't be a weighting on it. So there is some pricing in of 0. While the market is cutting rates on the long end. Interesting fight we have going on here. Anyways, 10 days, we'll find out. We're in a quiet period now, so you're not going to hear from anyone. So nobody's going to say anything, so we don't really know what they're thinking at this point. We'll just have to wait for the first. PCE, January 27th. That's the end of the week, Friday. That's 5 days. PCE usually follows along with CPI. CPI came in for the market quite joyful. So I don't know that PCE is going to tell a significantly different story. So, there's the possibility that the market could see the PCE and throw another party thinking it's a different reading than CPI, but it's just a different version of the same reading. It's the same information. It should tell pretty much the same story. Let's look at our curve inversions here. The 2-year to 10-year, negative 66 basis points. That's 200 days now. And the big one here, the 3-month to the 10-year, is 88 days. This makes it so much more difficult for credit creation on the longer end of the curve because you have an inversion of 124 basis points. How you got to really work as a bank to engineer an upward sloping yield curve when you have that much inversion. So it is going to slow down credit creation. And we did get some information from the banks reporting about their loan growth and what their forecast for loan growth is, and it's low. The key here is 88 days. We're almost at 90 days here. And this is almost 7 months. Another 10 days, we're at 7 months. Another 2 days here, we're at 90 days. Whenever both of these, at any time, whenever they inverted, well, first of all, this has a 100% hit rate for a recession to follow on. But the 2s to the 10s, whenever it's lasted more than 90 days, it has always been followed by a recession. So when we're looking for recession signals, Now they're not predictors; these are signals. They're nothing. It's difficult to find something that has predictive power. It usually is a signal in combination with other signals, so that the more signals you have, the higher the probability of the recession. Both of these are signals, and when they invert, it's a signal. And remember, I talked about depth times duration. Well, duration is the amount of time. Since both of these are pretty much more than 3 months at this point in time, or 3 months or more, there has never not been a recession when you've had an inversion of either one of those two for more than 3 months. Again, every inversion of the 3-month 10-year. Now you could point out, well, we had one in 2019 and it didn't cause a recession. Had the pandemic not happened, a lot of the indicators were pointing to a recession already, that the pandemic really just cleared that out and got it out of the way very quickly. 100% hit over here. For the 200, every time it's more than 3 months, 100% hit over here. So that begins to increase probabilities. The Fed balance sheet continues its march down, another 20.35 billion taken off, now sitting at 7.977 trillion. Last week was 7.997. We're just moving nines and sevens around here. T-bills $1 billion down. U.S. Treasuries $15.5 billion. TIPS $2.5 billion rolled off, and MBS $1.5 billion has rolled off. The current federal funds, the effective federal funds rate sitting at 4.33. That's from the New York Fed's site. When it comes to a lot of the market operations, well, all the market operations, they're all conducted through the New York Fed, so it is a good source of information. Reverse repo facility January 13th was 2.179 trillion. January 20th dropped now 2.09 trillion, another drop of 89 billion. It has not been under 2 trillion for a very, very long time. So even printing under 2 trillion, a 1.9 something trillion, is a psychological number, because you haven't seen 1 point something for a very long time, much like the 7 was a psychological number here, because we were over 8 trillion for such a long time. Now we're seeing 7s. So if this continues on and we print 1.9 something trillion, it probably is going to be talked about, because it's just being elevated over 2 trillion for such a long period of time. And this is costly, right? Because it's being paid 4.3 one-day SOFR. That is money flowing into the banks from the central bank. 4.3% on that 2 trillion. So the lower that gets, the better it is in terms of the direction of the cash flow. Maybe the worse it gets for the banks, because they're not getting that money is part of their capitalization in that sense, because it's free money. But with a lower rate volatility, they can find a lot of room in the 1 month, 2 month, 3 month, 4 month, even the 6 month, 4.8 on the 6 month. They can sit there. If you have low volatility and the Fed is near the end of the rate hiking cycle, the sensitivity of these drops, because, well, it's sensitive to changes in rates, and if rates are going to stay stable at an elevated level, the duration risk in here is minimal. And then this is the Treasury having to pay for it instead of the central bank. Either way, it's your tax dollars that has to finance this and flow into the banks. Last week, we've done this. Let's look at June 14th. This is rather interesting as well. 5.75 has now got 0 probability. It had a 0.3. We could say that it's almost nothing. But last week, on June 14th, there was no 4.5. It was 0%. But now there is a small little percentage muscling its way into 4.5. All the weight has shifted downwards here. The 5 is now at 51.3. from 48.6, and the 4.75, 11.2 from 8.7. So the market is really thinking that the Fed is pretty much done, if they're not done already. There are some people who think, no, they're already done. We'll find out February 1st that they're done. And there is more weight thinking that, well, they only have one more. And they'll go to 4.75. And if they don't have one more, at most they'll go to 5, because if we're looking at the weight here, it's pretty much on the 5. You still have some at 5.25, but it's been 2 weeks now. It's been dropping. So it's going to be interesting to see how that's played out. My thesis is quite simple, that unless you introduce slack into the labor market, you're not going to get a rate cut. Because if you do get a rate cut that spurs economic activity, you're going to push up against wage inflation right away, and suddenly inflation is back, and we're back in the 70s with Arthur Burns with the stop and go, stop and go, stop and go. And these people who are at the height of their career, because they're central bankers now, that is the culmination of a career of service, are not going to want to be remembered with their picture on the walls as that guy or that person that did this, another Arthur Burns. Nobody wants to be remembered as that. So unless you introduce some slack into the labor market, rates are going to stay higher for longer, so that I believe that this is probably premature at this point in time. Our real rates have all decreased from the 5-year to the 30-year. The 5 to 10-year segment of this curve is still inverted, 8 basis points. Last week it was 9 basis points, so it really hasn't changed. Inflation expectations just a little bit higher, but those moves just really aren't. It doesn't really signal to me that there's a big change in sentiment going on there. Those are just small little moves based on moves in real and nominal rates. The Fed Fund Futures curve last week was bottoming out May, June, July around 95.085. So you had an implied policy rate of around 4.91, 4.92, suggesting a range somewhere between 4.75 and 5.25. Here we're bottoming out in June and July at 95.105. So the rate is 4.895, just slightly lower than this, to the point of saying, well, other than just, trading, if trading had gone on for 5 more minutes, maybe it might be different. That's so very close. The end of the year, 2023 for December, 95.495. Last week was 95.44. So the December terminal rate implied by the futures, 4.56 down to 4.505. That's enough to suggest that there is some buying of this particular contract. And when you buy this contract, you are shorting the rate, the internal rate, meaning that you think the rate will go down. Hard to tell whether or not that shorting is coming from more of the market saying a recession is going to occur, hence this rate is really going to drop, or the Fed's going to change. The Fed's going to start dropping rates as soon as they see that inflation is going away. That's not going to happen. Let me give you an analogy for where the Fed is right now. And remember what I said on the previous screen. You have a group of people who are at the pinnacle of their career. There really only are 12 Federal Reserve bankers for each of the districts in the U.S. at any given time. There's only 12. It's a very, very small group. Their picture is going to be on a wall for a very long period of time. When you get to that level, you become very concerned with how you're going to be remembered. You become concerned with your legacy. If you're middle management in a cubicle on the 3rd floor somewhere, you're not too concerned that how you're going to be remembered 50 years or 100 years from now. But when you're in one of these positions, you are, at that point in time, acting in history. Because in 20 years or 30 years, you will be part of that history. Especially the Federal Reserve chair is going to be part of history. We still talk about Arthur Burns. And not in a very positive way, more in a sort of a bumbling sort of way, that he was one of the most ineffective Fed chairs. Well, do you want that to be your legacy? Do you want to be remembered as ineffective? So they're not going to repeat the mistakes of the past, and they've learned very well from Arthur Burns that we don't want to be him. Look at the way we're talking about Arthur Burns today. And fast forward 50 years, do you want our name to be substituted for Arthur Burns? No way. Nobody wants that. So they are going to err on the side of personal reputation caution. Think about it this way, and this is, I think, an apt analogy for where the Federal Reserve is right now. Here's your cabin in the woods, and you've got, all the forest and trees around your cabin. And there is a pack of wolves outside your cabin. And you can see them out of every window, and they're circling. There's a pack of wolves. Well, you're not leaving your house. You are not leaving your house. And just in case you think they're friendly dogs, try it. Just make sure you get it on a GoPro so that we can all see it. You'll be ripped apart. You're not leaving your cabin. Now you see them retreat into the woods. Okay, they're all retreating into the woods. I guess it's safe for me to come out. Would you do that as they're retreating? No. You're not leaving your cabin until you're absolutely certain that those wolves are gone, because you're about self-preservation. Well, to think that as inflation is coming down this year, we see it kind of go to 4.2, 4.1, 4, 3.9, that the Fed is going to start coming out of the cabin as inflation is retreating into the woods, is the same thing as saying, okay, the wolves are walking the other way. I guess I can leave my cabin door now. First of all, those wolves are a lot faster than you are. They can cover 20 yards while you cover 2. So there's no way you're going to have a long lead off of first base with a pack of wolves around you. Well, what do? They go in and they lay down. This is what wolves do. They're super, super smart. They lay down so that you can't see them. They all lay down in the grass. So now you look out your window, you can't see them. But you have to know that that's what wolves do. You have to outweight them. You want to make sure that those wolves are well on their way before you leave that cabin. Well, this is the Fed, and this is inflation. And inflation may be heading the other way into the woods right now, but the Fed can still see it. They're not leaving the cabin. And then inflation will get into the woods, and it'll probably hang out there for a while. I think Mohamed El-Arian has it right in saying that the frothy parts of inflation are falling off very quickly, giving the impression that inflation is falling down, but it will hit those sticky components at around 4% and probably go sideways. And if it goes sideways at 4%, that is the wolves laying down in the grass over here, and the Fed inside, knowing what they know about wolves, are going to say, they're in the grass. They're in the grass. I'm not leaving my house because they're in the grass, because as soon as I leave my house, they're going to come out. Leaving your house is lowering interest rates, or leaving the cottage is lowering interest rates. So that's where we are right now. You can see the wolves walking away, but the point is you can still see the wolves from your window. Are you going to leave the cabin just because they're walking away? Absolutely not. You want them to be long gone before you leave the cabin. And same with the Fed. Same with the Fed. Let's look at the 1 year forward minus the current 1 year. The 1 year forward is 360, so it is pricing in rate cuts. The current 1 year is 4.68. What this is saying is that in 1 year, we expect the 1 year rate to be 3.6. The 1 year rate right now is probably the longest rate that reflects current Fed policy. It doesn't really plan ahead too much. It really just looks where it is. So 3.6, that's 98 basis points worth of cuts planned over either a combination of this year or a weighted average of the following year that shows up in the 1 year at 3.6. It was negative 94 last week, so it's being even more aggressive in saying, no, there are rate cuts. Well, is it because they think the Fed is going to leave the cottage while the wolves are retreating? Or do they think that, a recession is going to show up and basically just kill those wolves outside where they stand? Which one? I don't know. If we look at SOFR, 3-month SOFR, this is the code for it. And if you get confused, when you see these kind of codes down here, if you get confused between them, the first couple of letters signifies the contract. So ZQ is the futures contract, for the ticker for the Fed funds futures. SR3 is the contract for 3-month SOFR. SR, there's the S, there's the R, there's the 3, there's the 3. The last number tells you what calendar year it is. So it doesn't write out 2023, 2024. It just writes the last number. So look at all these. See how they end in 3? That means it's all 2023. All 2023. So the first two tell you the contract. The last number tell you the year. So this here tells me it's 2024. And then Z is December. So if we look way down here, ZQ is the contract. 3 is 2023. Z is December. So you can, if you know the codes, you can look at any code and you pretty much know what it is. You could just look at the last number to tell you what year it is, and you can look at the first two or three to tell you what contract it is, and you may not understand, well, Z, I don't understand any of the Z's, the Q's, the X's, I can't remember them. They do go in alphabetical order as you go from January to December. They'll go from, here's F, G, H, J, K, M, and so they will increment up in order of the alphabet. You can't get further than Z, so if you're looking at a Z, well, it's got to be December. So this is SR, SOFR, 3-month, Z December 4, 2024, is at 97.12. So the terminal rate they're pricing in for December 2023 right now is about 4.5%. If we go out 1 year further, we're at 2.875%. That gives you an idea of what the market thinks the rate cuts are going to be over 2024. Because if we end December at 4.5 and we end the next December at 2.875, we can quickly figure out what the rate, what kind of rate cuts we're looking at. So let's look at Z3. This is SR3Z3 for December using the 3-month SOFR contract. It's at 95.655, which gives you the December 23 rate of 4.345, the December 2024 rate, 147 basis points of cuts. Now, I do this because I don't have the 2024 futures for this, and it will be low volume to be almost not very useful at all. It'll be stale pricing. So we'll use 3-month SOFR. 150 basis point cut over the month over 2024. We're looking at roughly 1 or 2 more rate hikes, ending the year at 4.5, and then another 150 basis points of rate cuts into 2024 under a soft landing scenario. Now, the soft landing scenario is the scenario where you see the wolves retreat into the bush and then they lay down in the, I say bush because if you're from northern Ontario, it's not a forest, it's a bush. Wolves don't live in the forest. The forests are southern. The bush is northern, so they lay down in the bush and you can't see them. That doesn't mean they're gone, right? So that is a soft landing scenario as you're looking out going, I know they're out there somewhere. So there can be no personal growth because you're not going to leave that cabin and explore, right? So that low growth scenario, using the same analogy, is your fear that the wolves are still out there and you're not leaving that cabin. So I don't know, that with this slow pace of rates, it seems like, it seems more of a soft landing scenario. I just don't agree with these outcomes. I think we have a quantum market at this point, and if you know anything about quantum physics, even on a slight level, it's the discovery that atoms don't move in a continuous line, but atoms go from one point to another point, and the distance between them is called a quantum. And that's what I think we have in the market, is a quantum market. You're either going to have no rate cuts at all, or you're going to have a whole bunch of rate cuts, but I don't think that you have a continuous move in there. I don't think that the Fed moves forward as inflation moves back. Much like you would not leave the cabin just because you see the wolves walking into the forest. You wouldn't do it. Let's look at TLT. I've had no position changes on TLT for the week. It hasn't really done much. Ended the week at down 0.3%. Again, this is week over week, not wow. SPY was down 0.53%, so bonds outperformed equities during the course of the week. Implied volatility has gone up a little bit. 13-week implied volatility at 6%. It was 3. 26-week is 21. It was 19, and just a small little move on the 52 because, well, this is the only thing that really will have the big moves, because any change in volatility now is, well, it's now, right? OAS. Look at this. Another week of doing absolutely nothing. Hardly moving at all, up and down, little bits here and there, but not much to talk about at all. This is rather surprising here that there's even less perceived risk in Triple C, but somehow more perceived risk in Double B. That just seems rather odd, but they're such small moves, and these are such illiquid markets to begin with, that when you see these kind of small moves, it's like, wow, had there been one more trade, it might end up being different. So being that it's not any kind of big move in any one direction. All of this to me looks no change. It's unch over the week. This is getting interesting over here. Let's have a look at the mortgage rates. The 30-year fixed rate mortgage down to 6.15, dropped 18 basis points over the week. The 10-year dropped 1 basis point. And the 30-year fixed dropped 18. So the spread is now contracted by 17 basis points. Look at mortgage apps. Week ending January 17th, up 28%. 28%. Refis, 34%. This is the refi index. It's not that you had a 34% increase in refis. It's the index itself that measures refinancing activity. The index up 34.2%. Purchase up 24.7%. That is a robust mortgage market. You keep this coming down, you start printing a 5 something. And I don't know that you're going to see a lot of downside in housing prices because demand seems to want to come right back in. And we are seeing some of it in some of the data that we're getting. Remember now, whenever you get negative data and it's dropping, when it starts to become less negative and start doing this, that inflection point, that is when the activity in the equities that track this particular sector, the stock market, starts turning up, or the sector starts turning up when the bad news is turning less and less bad. And we are kind of getting a little bit of that here. The housing market index came in at 35. Last time was 31. The expectation was for it to stay at 31, that this anything under 50 is in contraction, that it's not going to show any life. But it going from 31 to 35 is an increase in activity. Even though this is still in contraction, it's an increase. It beat expectations. Building permits for December down 1.6%, coming off November, which was also down 10.6%. So it came in at 1.33 million versus 1.35 million. This missed expectations. This is a leading indicator. Housing starts beat expectations, a drop of 1.4% versus a drop of 1.8% the previous period, but the expectation was for a deeper drop. So it beat expectations. Existing home sales came in at negative 1.5%, which also beat the expectation. The December existing home sales were down 7.9% month over month. December was only down 1.5% month over month. So existing home sales for December beat the expectation. This is the previous. That's not the expectation. Okay, that's the previous. There was an expectation that it would be, I think it was negative 2.1. Came in at negative 1.5. Beat expectations. Housing starts beat expectations. Housing market index beat expectation. Mortgage apps off the charts on this one, up 28.9%. The mortgage rate dropping. Does this sound like you have tightening financial conditions in this market? These conditions are loosening, and as these conditions are loosening, activity is, I wouldn't say picking up, but certainly not as negative as was expected. It was less negative, but that is it. That's called an inflection point. And that is usually the beginning of the bullish signals in that particular sector. Okay, let's turn our attention to jobs and the expectation for hiring, because this is probably the big thing to watch right now. Is if you cannot put slack into the labor market. And last week I drew out the labor supply curve, very steep and upward sloping, which means any small change in employment results in big changes in wages paid. So wage inflation is just going to come back. You have to introduce slack into the labor market. This is not helping. Initial jobless claims under 200,000 now, seasonally adjusted 190,000. Non-seasonally adjusted, they dropped by 53,000. Seasonally adjusted dropped by 15,000. Empire State came out this last week, and it has a bunch of sub-indexes. Two of the sub-indexes are number of employees and average employee work week. As far as introducing slack, now this is just manufacturing. As far as introducing slack, you can see on both ends of the index here, they're dipping down. But here's how we read this. Percent reporting higher and percent reporting lower. And this is a diffusion index, right? So in December, 24% of respondents were saying that they are going to add employees. Only 10% said they were going to reduce employees. When we get to January, only 16% said they're going to add, and now almost 14% said they're going to go lower. So it is negative. Well, that helps to introduce slack into the job market. And if we look at average employee work week, we have in December 8.5% of respondents said that they plan to increase the work week. That's now dropped to 7.4%. And to reduce the work week was 13.1%. That is now 17.8%. That came in negative, meaning that what we have here is we think we're going to require fewer employees on a going forward basis, and they'll be working less. That begins to introduce slack, but when you see initial jobless claims at 190, that is still a tight labor market. That means that those people who are losing jobs, and every month some 5 million people are separated from their jobs. 5-6 million people are separated from their jobs, and 5-6 million jobs are people are hired to jobs. So when we get the jobs report, that is the net gain in jobs. That is not just like when we saw last month 223,000. That's not like, 223,000 people got jobs. No. Some 6 million people were hired, but some 5.7 million were let go. So that the net gain was that. Well, if you have 6 million people a month losing their job, you have 1.5 million a week, and only 190,000 are showing up, meaning that the others are just not going to the unemployment line. Now, this is an insurance policy. Unemployment is insurance. It's not a government handout. It's insurance. It's an insurance policy that you pay into. So why wouldn't you? To say, well, maybe they just don't go and collect unemployment. Well, that would be like your house burning down and you say, no, I don't need the insurance payout. Thank you very much. No, of course you'd take it if you're entitled to it. So if they're not showing up to file for initial claims, it's because they don't need it. So that this is going in the wrong direction if we want a tight labor market. But these are, signals in the right direction. But again, this is the manufacturing index. The big one we're waiting for January 31st is ECI, the Employment Cost Index. So what average hourly earnings does is it is strongly affected by the mix of workers. So you can get average hourly earnings to show very, very small growth if all of your job gains come from part-time workers. If they come from younger workers and less educated workers, well, you tend to pay them less. Average hourly earnings wouldn't show that much of an increase because of the mix. But the ECI doesn't do that because it says, here's a job. It doesn't pay attention to the person. It says, here's the job in this month. Here's the job in this month. How much more is that job being paid? So it looks at the job, the same job month over month over month over month. Not the worker, not that while you hired somebody that was cheaper to hire, if that was the job. So it looks at the job and its wages plus benefits. It's all in. That's where you get your employment cost. Inflation is an all-in number because you could say, well, I only raised wages 2%, but I raised benefits 10%. Well, then that's cost inflation, right? January 31st, we get that in 9 days. Next week, we get Richmond Fed and Kansas City. We also get from the Chicago Fed the National Activity Index on January 26th. So we get two of them, and they all have subcomponents for inflation. We're going to look at two of them, two different ones right now. Okay, let's start with Empire State. Survey responses were collected between January 3rd and January 10th. It starts off with just an executive summary of what you'll see in the charts. Activity tumbles, employment growth stalls, firms expect conditions to remain weak. The first chart gives you the index at the macro level without the sub-indexes, just general business conditions. You can see it just falling off into 2023. Look at where it is in 2023. Let's go all the way back to the great financial crisis. There's where it stood. I don't know if any of you remember that, but those were some pretty dark times when we thought the economy is just going to fall apart at this point. Credit had just frozen up completely. That's where we are now. That's where manufacturing sits, at the same level it did in the depth of the recession. So it is well into contraction territory here. It says up here, the general business conditions index fell 22 points to negative 32.9, its lowest level since mid-2020 and the fifth worst reading in the survey's history. That's wild, eh? You can go into current indicators, and these are all the sub-indexes. Here's general business conditions, new orders just dropping off, shipments just dropping off, unfilled orders dropping because, well, you can fill all those orders now. That's sort of a signal that supply issues are resolving themselves. Let's go down. Inventories is important here. You see that as 0.8. It is quite typical that you see inventories build in the final parts of the slowdown, leading to the contraction. And building inventories can actually cause a contraction because companies say, well, we have a buildup of inventories. Let's cut back on overtime. We don't need all the overtime. We don't need the extra shifts, and we can lower the amount of hours worked per week because we can sell from inventory at this point, and demand is dropping off, so we have enough out of inventory. And it's the release of those employees which then reduces aggregate incomes in the economy, which reduces aggregate demand, which reduces inflation, but causes the recession if it's done on a large enough scale. I think this week coming up, we get business inventories. We get a economic report on business inventories and not just one of these small little regional samples. Going into number of employees, you see it dropping here, and average employee work week. So you can look at all the sub-indexes. This one gets all the attention lately, prices paid and prices received, especially the prices paid. But let's just look at it, negative 17.5, that's a big negative number. So you look at that and say, oh, prices are really coming down, negative 6.4 on this index, prices received are really coming down, inflation's going away. But let's just look at some numbers here. Percent reporting higher prices paid in December. 50% of firms were saying we're paying higher prices. The other 49.5 saying, no, neither higher nor lower. When you get into January, roughly 40% are saying, yeah, prices paid will be higher. 6.3 are saying, yeah, we're seeing some effect here. We'll have lower prices. And then the rest are saying, no difference. Still, 40% are reporting that they're going to be paying higher prices. 4 out of 10 are saying that. When we look at prices received, December, 29% that they said that they're getting higher prices. January, 23% are saying they get higher prices. So you still have inflationary pressure, just at a slower rate, but it's not like it's disappearing. Now, if this said prices received, if that was a 0 and lower was like 42, then we would say, oh, wow, that is a crash in prices. There goes inflation, most definitely. But this, at this pace, inflation is not going to whittle away down to the 2% target by the end of this year. That just isn't going to happen. Now, this is just a sub-index in a manufacturing sector, just in one little region. But still, it's evidence of something. Let's look at the Philly Fed. This one here is from the Philly Fed. Responses were collected from January 9th to January 17th. Again, the first part, they have future activity, current activity. First part is just, a synopsis. Current indicators remain weak. Prices paid index near long-run average. Prices received index remains elevated. Firms expect smaller cost increases for 2023. And it gives it to you in a table. Here are all the sub-indexes, right? This is the general business activity across here for January versus December. The next one is they're asking, 6 months from now, how do you feel? It gives what the previous index was and what the change is. So it went from negative 13.7 to negative 8.9. Still in contraction, but again, you have it less negative than it was before. And for 6 months out, it was negative 0.9, and it is 4.9. Then you have all of the sub-indexes. This one is interesting here. CapEx, the previous index was 16.2. 6 months from now, 10.5, which is a drop. This is what happens with business investment in uncertain times. it is the most volatile part of GDP. That if you took a ratio of the volatility in business investment to the volatility in GDP, just that ratio, it is almost 3 times higher. It is the single most volatile component of GDP, but today's investment is tomorrow's growth. So if you take away today's investment, you get lower future growth. So you're actually just hurting your own future growth here. 16.2 down to 10.5. This has been a fairly consistent trend when you look at capital orders and durable good orders and machinery orders from different economies in the world. We see them weaker because it is very natural, especially when the cost of capital is elevated and business conditions are uncertain, that you have lower capex. A good case in point, General Motors and LG announced, I think it was late Friday or early Saturday morning, that the 4th battery plant that they were going to build in the US has been suspended. It's now on hold. So you have companies that are canceling already announced capital investment plans. So they've just put that one on hold, which is kind of, falling in line with the general theme running through the auto industry right now, that this move into EV is going way too fast and it's only going to be a problem. And we're not even sure if electric is going to be the winning technology. We're not even sure that this is the answer. So they're already canceling that one, which is, not a good vote for EV, being that GM seemed to be all in. And it is just a symptom of the conditions that we're in, that whenever you have higher costs of capital with increased uncertainty, business investment declines. And it is the most volatile component. So if that declines, then your future growth that would have created also declines as well. Let's look at prices paid. 36.3 was the previous, down to 24.5. But this is interesting. When asked to look out 6 months, 25.7. 24.5 for January, 25.7. You're not seeing much change here. But prices received, 29.9. Asked to look out 6 months, 21.3. So that my input costs, I don't see them changing much, but the prices that I can charge, I see them dropping. There is some story about margins. And we know from previous market outlooks, I presented it before, the ratio of corporate profits to GDP is sitting at all-time highs. That's the share of income in the economy that corporations are grabbing, is sitting at all-time highs, but you have wage inflation. So something has to give. You can't stay at 12% and keep raising your prices to preserve 12%. And if you try to save your margins, you're either going to have to lay off people, which will lower aggregate demand just to preserve your margins, or we're going to have to live with inflation for much longer. But we all forget that corporations are self-interested as well when we think, inflation is disappearing. Yeah, but corporations still are going to try to make their margins. So if they see their margin being compressed because prices paid aren't coming down as fast as they can raise their price, well, they'll either lay off people, which will lower aggregate demand, or if they can, they will raise their price. In this past week, we saw Procter & Gamble report earnings, and that's the thing they said, is that we can't really pass on all these costs anymore. We're at the limit of what we can raise our prices by, but our costs are still going up. So Procter & Gamble took a hit. And I think that's going to be a story for the earnings season going forward, is the story of margin compression. If margins were 4% of GDP with the long-term average at 6%, it wouldn't be so bad because, they're below the long-run average. But when you're sitting at all-time high margins, with input costs rising as they are and lower and lower ability to keep raising your prices, margins have to give. What else is interesting here? Number of employees for January here over December, 10.9 versus -9. So this region looks like it wants to add and increase the average work week. which is going to work against the very thing we saw in Empire Manufacturing, which was introducing some slack. This is going to pick up the slack. It's all about the job market now. Okay, we'll go through this screen, then we'll look at retail sales. If we're worried about an endogenously led recession, it is going to come from credit. It's very rare that it simply just comes from a consumer just rolling over saying, yeah, I give up, and then you end up in a recession. Usually there is a credit event that causes it. If you look at consumer sentiment, if you look at investor sentiment, they have very little correlation with GDP. In other words, they have almost zero predictive power. But when you look at credit sentiment, it has huge predictive power for GDP because credit is everything. So let's see what we have. Let's start in the corporate sector. Our OAS right now is extremely low. The cost of debt on BBB, 5.26. That's an all-in yield, by the way. On BB, 6.44. If we were thinking about, well, what is the cost of equity? Because equity is always going to be more than the cost of debt. This is BBB, this is DD, so this is the lower part of investment grade. This is high yield. Whatever the cost of debt, if you're looking at a company that is in investment grade, which pretty much all S&P 500 components are going to be investment grade, you take their cost of debt, let's take BBB as an average, 5.26, and you would think about, well, what's a decent equity risk premium? Most of the time we think it's about 450 basis points, and then multiplied by the beta to get some rough estimate of what your cost of equity is. I say that simply because we have to start thinking about capital. Capital is going to cost money. And all of the future cash flows of a business will be deducted at its weighted average cost of capital. We know that the cost of debt is elevated. And if the cost of debt is high, the cost of equity must be higher than the cost of debt because debt sits higher in the capital structure than equity does. Equity is a residual claim on assets. Debt is a first claim on assets. So it's going to have a higher cost. If we think soft landing and then we're just going to go sideways for a while, inflation's going to have a hard time at 4%, the sticky component's going to hang around for a while, you have to start raising your estimates of the cost of capital, which lowers the present value of all of those cash flows. Look what's going on here. Remember now, on the first screen, I showed you that capital market rates have all contracted. So the market is already cutting interest rates by some 40 basis points. Last week, I showed you issuance of corporate bonds for December were almost fell off to almost nothing. So far, for January, on track for $150 billion of IG issuance. The record was $174 billion in January of 2017. You're pushing up against 150 because the market has cut interest rates by 40 basis points. So the market has cut interest rates by 40 basis points and companies are taking that advantage to load up on debt. Now here is why that is probably a safe thing to do and not as costly as what you might think. Interest payments are tax deductible, so they don't really pay the cost of debt. It's the RD1, so their after-tax cost of that capital is 1 minus RD1 minus the tax rate. Not only that, they do have the ability to hedge. So let's say that you issue your fixed rate coupon bond at 5.26% and you are expecting that there is going to be a recession. And if there's going to be a recession, there's going to be a cash flow problem. And if there is, we better put cash on our balance sheet now. Let's borrow what we can. So you can look at that amount of borrowing and say, well, companies plan to invest a lot, but not if you look at CapEx. All planned CapEx is being lowered or even being cut, but bond issuance is up. So this tells me that they're taking the opportunity to add cash to their balance sheet in anticipation of a recession. And if you anticipate a recession, what's going to happen with short-term interest rates? They're going to drop. So you're paying 5.26% and interest rates are going to drop. You would think, why wouldn't you just wait then? Because as this starts to approach, you then enter into a swap. You then enter a swap where you will receive fixed and pay floating. So you're paying a fixed rate of 5.26%. You'll enter into a swap where you receive a fixed payment to make your fixed payment. So what you receive takes care of what you have to pay, and you end up with floating rate debt while interest rates are dropping. So you can turn your fixed rate bond into a floating rate bond with a derivative. So being that the market is receptive to debt issuance right now, may as well issue debt right now. Because if there is a recession coming, your cash flows from other sources are going to slow down. You may as well fortress up that balance sheet. Because how else can you explain almost a record issuance, on track for almost a record issuance when we're at 5.26. The record was 174 in January 2017 at lower rates. And it's not CapEx. Household wealth is very, very high. Net worth of 163 trillion. Net worth of 163 trillion. Home equity is high, as we showed last week, 29.55 trillion. And this is the widest ever between this is the equity. So in other words, you look at the price of the house minus the liability, which is the mortgage, and the gap between here is your equity, the widest it's ever been. On consumer credit, delinquency and default rates are rising, but lower than pre-pandemic. But yes, they are turning up. They are turning up. So if you're looking at, well, hang on a second, it's the direction that matters and they're moving upwards, yes, but there's a long-term rate. And even though they've turned up, they're still below the long-term rate. So they may do this, right? They may just revert to the long-term average. But to give the bears they're due on this one, yes. Delinquency rates are rising. Default rates are rising. If we look at credit card write-offs, they're rising, the net charge-offs. If we're looking at subprime auto loans, the default rates are rising. If you're looking at credit cards, delinquency rates in credit cards, meaning they're more than 30 days past their payment, that's a delinquency, yes, they are rising. They're all rising in that sense. But from very historically low levels, and they're rising right now to a long-term average. Will they grow past that is the question. Also, if we're looking for the corporate sector, you can look at the banks and what their net charge-offs are. Their net charge-offs are rising, but again, below their long-term rates. JP Morgan says they expect that their net charge-offs are going to increase this year. And they put it at 2.6% of their loan book for their net charge-offs, which is lower than what their long-term average is, but it is rising. The banking sector balance sheets are very strong. If we look at loan growth, just in Q4 of 2022, JP Morgan 7%, Wells Fargo loan growth of 8.4%, Citigroup loan growth of 5.81%, and they all are in the range of low to high single-digit loan growth for a forecast for 2023, which is low loan growth historically, which is low. So they're seeing growth in credit being lower, which, well, that's what higher rates do. But you still have some companies that can access public markets, right? So they're heading to public markets. If we look at the Federal Reserve, they have one table, the Z1 financial accounts. So they give assets, liabilities, and net worth. So you can pull it right off that chart. Assets at 163 trillion. I put net worth at 163 trillion. Sorry, let me change that. Where is my pen here? Let's get rid of that 6. I put 163 as net worth when it's actually the assets. The net worth is 143. Assets 163 trillion, liabilities 19.2, net worth 143 trillion. To put that in perspective, they have another chart that you can use which shows the percent of disposable personal income. So assets as a percent of the disposable personal income is 873%. We tend to focus on this when we say consumer debt is 103% of their disposable personal income. Yeah, but assets are 873, right? We keep forgetting, yeah, there's a lot of debt, but there's a lot of assets. There's a lot of equity. So from a credit perspective, I don't see that this can cause a recession. And typically when you have endogenously led recessions because you have low growth, it's typically something in the credit market that's going to do it. That's the big thing. Yes, delinquency and default rates are rising. Yes, net charge-offs are increasing. Yes, loan loss provisions are increasing, but they are still below pre-pandemic levels. But yes, they are increasing. Higher for longer would mean that you would expect that to also increase as well. That will put more people in delinquency, more people in default. But let's be clear, it's still below pre-pandemic levels, but it's just not moving in a healthy direction. The most interesting part to me is this. Right up here is all that issuance. And it made a lot of sense. If the market is going to cut interest rates by 40 basis points in the capital market, why not issue capital market securities? You've already had a rate cut, a 40 basis point rate cut. Why not issue securities and fortress up our balance sheet? We'll cut back on some employment. We'll cut back on CapEx. We'll start to preserve our cash flow. And if a recession shows up, we got enough cash to weather through whatever recession we're going to have, mild, severe, whatever the case is, we have enough. And if that is going to be the case, we always have swaps, which will help us lower our interest rate with the floating rate as it goes down. It's a win-win all the way around. Okay, let's have a look at the retail sales report. This is from census.gov. December 2022. 677.1 billion, down 1.1% over November, and November was already down over October. Let's go to the second table, not table 1, but table 2 gives us a nice glance at this. This is December 2022 from November and from the previous December. And remember, November, when I showed you, had a bunch of negative signs, so that November's retail sales were down from October. And this is December, and it's showing that it's down from November. So November was a step down from October, and then December was a step down from that over November. Negative 1.1, negative 1, negative 8, negative, 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 negative. In fact, as you go down, look at all the negatives. Negative, negative 4.6, negative 0.3, negative 0.8, negative 6.6, negative 1.1, negative 1.1. You got a few positives in there. There's just nothing good there. And if you look at over the year before, December 2021, retail sales don't adjust for inflation, so these are nominal numbers. So if the inflation rate for December year over year is, I think the headline was almost 6% on the headline, 5.7, 6%. So if you look at these numbers, anything under 5 point something percent is underperforming. Well, I shouldn't say that because some of these categories didn't have the same level of inflation, but you'd have to look at all of them here. 6% year over year, that is barely above inflation. That after you adjust for the price level, what is that, flat year over year? And, you've had a decline from a decline from October to November, another decline from November to December. So there's nothing good in the retail sales report. Okay, let's look at earnings and expectations. This has dropped a little bit here. 2022 Q4 year-over-year earnings expected to be negative 2.9. If you exclude the energy sector, negative 7.3. Let's see, during the week of January 23rd, 88 S&P 500 companies are expected to report quarterly earnings, and I think next week we go to like 170 some that are reporting. This is not a good trend. Usually expectations drop before earnings. Analysts lower their expectations, and then companies start beating expectations and they ratchet them back up again, but this has just been coming straight down and dropping. Let's look at 2023. Let's find it here. 2023 earnings growth rate. This is now 0.1%. I think it was 0.4% or 0.5% last week. Now it's 0.1% because this is incorporating some guidance as well. Lots of negative numbers coming in here. And I think only 50 some companies have reported, and we're already there. Let's go down to the, here we are here. Forward 4 quarters, 226.23. That is $1.50 lower than it was last week. Last week was 227 and change. Now we're down to 226.23. I will show you S&P Global in a second. They have a nice spreadsheet. I've introduced this one to you before. They have a weekly spreadsheet that you can download. So we'll have a look at that spreadsheet. They're at 225. They're actually lower than the 226. They're at 225. And I have heard some estimates and well, not just some, more and more now clustering around the 190 to 200 range for 2023. That these are just way too high. That the market is not pricing in the binary scenarios of it'll be higher for longer. And higher for longer means that cost of capital is going to be elevated for an extended period of time. The present value of those earnings are way too high. So that means that the market price is way too high right now, and that there is going to be margin compression, and those earnings are also too high. Versus the other scenario, the other binary outcome, which is the recession. And in recessions, earnings drop sometimes up to 30%. That means you could be down to as low as 150, 160 on earnings. I've heard of 150 before, but 200 seems to be where a lot of the weight is starting to concentrate, and we're sitting at 226. And the multiple typically in recessions bottoms out before earnings bottoms out. So you can get a multiple down to 15 while earnings are still on their way to 200. So if you get a 15 while earnings are at 220, you're sitting at around 3,300 on the index. It's hard to see how we maintain 4,000 on the index, given margin compression that we're already seeing. Given what P&G said this last week, is that we're at the limits of what we can raise prices. We're now just taking a margin hit. Tech companies laying off to preserve their margins. It's hard to see how companies can maintain record high margins, record high earnings as a percent of GDP in the face of all this. So that was a big drop. It doesn't sound like much. I think it's $1.44, but still over a 1 week period to have $1.44 when only out of the result of what, some 20 companies that are reported over the last week, 30 companies. And then we have a list later on of all the companies reporting, but S&P provides a better list. So let's have a look at theirs. Okay, let's have a look at some numbers here. There's a lot in this spreadsheet. You can see all the tabs along the bottom as well. So on the first screen, if we scroll down, I highlighted in yellow. The observation here is Q4 2022 expected. That's for Q4. This is all of 2022, and this is 2023. And you can see on different dates what the estimate was on different dates. So line 92 is current for Q4 2022. The current estimate is 53.18, which would put 2022 or trailing earnings at 199.76, and the estimate for 2023 is 225.35. You can see how it's come down. This is as of 2022, as of March 31st, it was 246. 1 quarter later, up to 249. End of September, 238. End of December, down to 226, and currently sitting at 225.35. Scroll down if you want to see it per quarter over here. The estimates for March 31st, 2023, June 30th, September 30th, and 12/31. These add up over here, the 225.35 that you get over there. Click on the last one for forward schedule, and here you are. It tells you all, it says 104 issues. There's 104, but 16 of them are Dow Jones. So 104 minus 16 leaves 88 S&P components, as we saw with the previous screen for this week in earnings. It tells you who's reporting, and in the order: Monday ATC after the close, and then Tuesday morning, Tuesday after the close, Wednesday morning. So it gives it to you in chronological order. Tells you what sector and what sub-industry they're in and the name of the company. So if you get to something that you just have never heard before, like this one here, healthcare, life sciences. So if there's particular industries that you're interested in, this gives you a nice at-a-glance look at who is in that particular industry. Where's the big one here that I'm rather interested in seeing? It's on the 25th. Where are they? They're in here somewhere after the close. Is it Thursday or is it Wednesday? I think it's Wednesday after the close. There it is right there. That is going to be super interesting. Not because I'm that invested in Tesla. It's just I'm very interested to see what happened to their margins, and if they're going to give any kind of forecast or outlook. I'm wondering if they're going to be, really optimistic about the future. Intel will be interesting as well. I think CSX, there's railroads. If it follows suit with HJB Hunt that we saw, transportation is just on fire. Lots of really interesting things next week, and because we're moving away from just financials but getting into a lot of other sectors as well, it's probably the first major week where we get a really good overall look at all the sectors of the economy. So I think next week's trading will be heavily influenced by this, but you do have PCE on Friday, and the market has shown a willingness to only throw parties when inflation goes down and to ignore other things. So even if earnings come in, negative, not negative numbers, but negative sentiment off of earnings, and PCE comes in light, the market could simply just say, it's all over now. The Fed is going to start cutting rates in, who knows, maybe by the end of when I'm doing this next week, there might even be a rate cut planned for February. When I say a rate cut planned, I mean that the market will start pricing in a rate cut for February, depending on what PCE looks like. Let's look at SPY. I am, when I think about taking a short position on the market, beyond being just neutral, beyond just a hedging point. In other words, I am going to adopt negative beta position, be net short. I want to make sure I'm right, because if you're long and you're wrong on an index, you can wait. You have the luxury of time. You can wait because over the long term, it goes back up. But that's just the whole point. Over the long term, it goes back up. So if you're short, you don't have the luxury of waiting. So you really do a lot of deep thinking about whether or not you want to take on negative beta. And I have decided that I want to take on negative beta. So let's see where we are here. We're going to use the FactSet earnings 226.23, not the S&P earnings, because we've always just used this. So why stop? Forward 4-quarter EPS 226.23 was 227.67 last week. That's a drop of $1.44. Closing SPX is 39.72.61, which puts us at, this is really interesting, 17.56. That is unchanged from the week before. The week before was 17.56. So the market is willing to pay the same multiple for decreasing earnings. I think that's interesting. 55 companies have reported to date. 55 companies. 88 companies from January 23rd to January 27th. We finished at roughly around 396. 18 times earnings brings us to 406.21. The 200-day moving average is 396.04, which is pretty much where we're sitting. The market has failed on this downtrend line every time it hit it. Failure, failure, failure. And it's one downtrend line. That's the important point. It is one single downtrend line. If we look at the uptrend from the October low, we had one particular uptrend until it broke that trend. Then you had to draw another uptrend line till it broke that trend. Then you had to draw another uptrend line. So these are called speed lines, meaning that you can see that they're getting slower and slower. So I heard a technical analyst, they had their chart up and they said, you see these lines over here, and if you forecast them out, they picked a certain date on the calendar and said, this will be resolved before this date on the calendar. We're either going to break up or we're really going to break down. Well, no, you're not. You could just simply do this and then go back up, and then you have to do a new line and a new line. He was only using the last line that he drew. You have to draw all the lines. You have to draw all the lines, not the last line. So on the bottom here, we can see that, we had an up move, and that up move slowed down. So you have a slower line. That's why they're called speed lines. And then that broke down, but still went sideways. So you have a slower line. So this could still be setting up for just nothing more than a sideways market between 375 and 400. But we haven't been able to break the downtrend line. So the downtrend is still in place. 50-day moving average 392.05. Market kind of held on to that. Did have a close below it, but then came back up. Implied volatility is, not too attractive still. 13 weeks, 6%, was 6%. 26 is 10, it was 12. 12 down to 12 was 15. The 20-day short straddle yielding 3.5%, which is still rather low. The Q1, I showed you this earlier, EPS growth. Q1 for 2024 EPS growth is now 0.1. It was 0.5. If you exclude energy, Q1 2023 EPS growth was forecast to be negative 1.7. It was negative 1.4. And revenue growth for Q1 2023, this is based on forward guidance and analysts updating their estimates, now 2.4, was 2.5. So that is coming down. The volatility here, 18.84, is unchanged over the week. Let's just look at some things here. If we take the multiple, 17.56, and we invert it, we get an earnings yield. That is earnings over price. You can do the math on that, and you can see that that comes to earnings over price. You have an earnings yield of 5.69% by buying equity. So if you buy a 6-month T-bill, you get 4.8%. If you buy high yield bonds, you get 7.99%. So high yield bonds are paying 8% yield, and equities, which sits lower in the capital structure, have an implied yield of 5.69. This means that if earnings grow at 5.69% and you're still willing to pay the same multiple, you will realize a yield of 5.69% because the price should increase by 5.69%. But you can get 4.8 on a 6-month T-bill guaranteed. You can get 8% on high yield over the course of a year. That's without defaults, of course, but 8%. So, by these measures, the equity market seems to be overpriced, or another way of saying it is you're getting almost nothing for the risk premium, which means by stepping out of bonds, lower into the corporate structure, into equities, you're not being paid anything more for doing that. So you're taking on more risk, but you're not getting any extra compensation based on the price that you're paying, based on the multiple that you're paying right now. So it seems like a rather expensive market, given that you have risk to the downside on earnings. It could be a really expensive market. 17 times is at 383.40. So I've added to my June ES position. Actually, on Thursday, because the market had dropped so much, I covered my ES position, and on Friday, as the market increased, I put another short out again at 401.5, this time for twice as many contracts as I previously had, because I am taking a net short position, and it closed at 402.250. So I am down 7.5 points on each contract, or $350 per contract. There's 50 points of carry in here. The market, SPX had a closing of 39.72. And the contract closes at 402.250. That's roughly 50 points higher. So I get 50 points of positive carry, but I am going to be negative short the market going into the earnings week, only because I can't make this work in my mind that you're getting paid almost nothing for the risk of going lower in the capital structure. A high yield bond with a 1 to 3 year horizon, an investment grade bond with a 1 to 3 year horizon pays 5.49%. 5.49, and you have an earnings yield of 5.69. Are you telling me the risk premium for equities is 20 basis points? I just can't square that in my head right now. So something is wrong. Either earnings are going to be significantly higher than what they are, and I get to buy at this multiple, or there just isn't a deal here. I'm not getting paid to take on the risk that is inherent in the distribution of returns, in which case I don't mind being short this particular market. All right, let's look at our economic calendar. And there are some big days for the U.S. Thursday and Friday are big days. Now layer on top of all of these days earnings before the bell and after the close every single day. January 23rd, Canada, new housing price index. We've already had some indication that housing prices have given way quite a bit. This is a big one for the U.S. here at 10 o'clock, the leading index. I think the forecast is for negative 0.7. It's been negative for, I think, 7 or 8 months now. And I've shown the leading economic indicator before, and it's already in recession territory. And we're not expecting it to change. Another negative increment month over month. Let's go into the next day. You got a bunch of PMIs showing up, and there is a 10 o'clock, 9:45. The PMI is 10 o'clock. There's Richmond Fed. You'll get a manufacturing index, and you'll get a services index for the Richmond Fed. Next day, I'm watching the mortgage apps again. That was a big number, 27.9%, and the previous 30-year mortgage rate was 6.23. Well, we have an even lower mortgage rate now, so let's see what happens on the mortgage applications front here. 10 o'clock, fellow Canadians, Bank of Canada interest rate decision. Expectation is for 25 basis points. I don't think that the Bank of Canada can be as hawkish as the U.S. only because the U.S. is primarily a lot of fixed rate mortgages. Canada, you got a lot of variable rate mortgages that reset. So the consumer is easier to tip over in Canada than it is in the U.S. And household debt as a percentage of disposable income is way higher in Canada than it is in the U.S. Something like, I think the last numbers I saw, 160, 170%, whereas in the U.S. we saw it was about 103%. So the Canadian household has a much higher duration than the U.S. household. And remember, duration is a sensitivity to changes in interest rates. So the Canadian household is far more sensitive to changes in interest rates for political purposes. I don't think the Bank of Canada can push that hard, even though it's supposed to be apolitical. It doesn't operate without political eyes looking at it. If it goes 25, I would expect that it probably would begin to signal that we're going to sit here for a while. I just don't know how the Canadian dollar is going to respond to this, but if you are trading the Canadian, be aware that you have huge event risk at 10 o'clock here. Continuing on, 11 o'clock, Bank of Canada Governor Meldrum, Tiff. Let's name our son Tiff. Tiff Meldrum will be speaking. What do we got going into the next day? U.S. building permits. This is the final look for December. That's not going to be as important as 8:30. Durable goods. Also, Q4 GDP. The first look at Q4 GDP. That's going to move things. And if that's not enough, let's layer on the Chicago Fed National Activity Index. And if that's not enough, there's going to be earnings Wednesday after the close that will affect Thursday morning opening, and there'll be earnings Thursday morning before the opening. So Thursday, what's going to win, right? Continuing jobless claims, again, another important number to look at. And then you have all the sub-indexes that come with anything reported for GDP. New home sales at 10 o'clock, and then we go into the next day where we get core PCE. And then an hour and a half later, you get hit again with consumer sentiment. And then we have the pending home sales. And again, this morning will be affected by the earnings release before the bell and the earnings release Thursday after the bell. So lots of big event risks near the end of the week, and all of this will change expectations for the Fed, which is the following Wednesday, and then the following Friday we get the jobs report for January. And before that, January 31st, the day before the Fed, you get the employment cost index, along with some 100 and some companies reporting earnings next week. So the next 2 weeks, you are trudging through the jungle with a hostile enemy engaging in guerrilla warfare. That's what the markets are like for the next 2 weeks. So be careful, keep your helmet on, and keep your head down.